Hey everybody, today is August 17th. It is the day after President Joe Biden has signed the Inflation Reduction Act. He signed it yesterday, Tuesday, August 16th. We are here to discuss the bill and potential impacts. My name is Jeff Rudner. I'm the co-founder and CEO of Proseer. Here with me are Larry Bernstein and Patrick Osborne. Larry and Patrick, can you introduce yourselves? Larry first.
Sure. My name is Larry Bernstein. I'm CEO here at Proseer and also involved in tax and systems and accounting for many clients. Happy to be here to talk about the bill.
Patrick, how about you?
Hey, I'm Patrick Osborne. I'm the head of tax here at Proseer.
Awesome. So let's kick it off. This is a big bill. It is been talked about a lot in the news, but let's break down some of the details. It's called the Inflation Reduction Act. It has a lot of components specifically related to climate change. It's funded in some interesting ways. So let's start. Let's start with the climate impacts of the bill. Larry, what's in here that is expected to have an impact on climate change?
There's quite a bit that's supposed to have an impact on climate change, but I think what might be interesting to most of our listeners is what's going to happen with EVs or electric vehicle tax credits. And so for some manufacturers, there was an EV tax credit of $7,500 per car, but for some that had sold over, I think 200,000 cars, that credit went away. And so Tesla doesn't have the credit anymore. GM does not have the credit anymore, but this bill brings it back and it removes that cap. So now all manufacturers who produce EVs but meet certain special conditions can get this $7,500 per car credit back for buyers. And so, there are a bunch of gotchas here though. So like, what are they? There are some on the manufacturer side that got to be assembled in the United States. A lot of the parts need to be from the United States or from other favored nations. Costs, sedans, hatchbacks, wagons, they need to be $55,000 or less. SUVs, pickup trucks, vans, etc., need to be $80,000 or less. So that's on the manufacturer side, what they can control. On the taxpayer side, there's now income limits. So if you're a married couple and you make more than $300,000 a year, well, you don't get this credit. And singles at $150,000, and there's a middle spot for head of household. So this is not a credit for high earners, but on a simplification procedure, I guess to make this easier, the credit is going to be available for dealers to apply at purchase. So that's a good sign.
Awesome. And Patrick, just to clarify some of the things that Larry mentioned, how does a tax credit differ from a deduction? What does that mean from a taxpayer's perspective? And how are they going to, what's the impact on a taxpayer on how they classify this?
Sure. So from a credit perspective, you're going to get a dollar for dollar reduction of tax. So it'll help reduce your tax liability by that $7,500 if you're qualifying for the full amount. What's interesting though is by allowing the dealers to take the credit, I think it's going to add some complexity that the IRS need to work into the systems to see who qualifies, how you're going to understand if they're over or under the wage limitation. That's an all or nothing test. So the second you're over it, credit goes away.
Mm-hmm.
So I think there's going to be a little bit of complexity that the IRS will have to come out with and figure before I think we can make it work.
And so with the credit, the way it's structured in this bill, Larry, you mentioned that the dealers are going to apply that. Does that mean that for a $40,000 car, you're going to walk out the door paying $32,500 after the credit?
If you can find a new EV for $40,000, then and you're under the income limits, then yes, that is true.
Well, I'm hopeful. This is called the Inflation Reduction Act, so I'm hopeful that it'll bring down the cost of the electric vehicles.
Now, there are also some new credits for used EVs, also subject to certain maximum purchase prices and even lower income thresholds. So you can be aware of those too.
Cool. Awesome.
Yeah, and what's interesting to note with both the electric vehicles and a lot of the other energy efficient credits is that the IRS is going to actually ask you for VIN numbers or other identifying information for the actual equipment or service or that you put into service. So it'll be interesting to see how the IRS adapts their systems to even account for that information. Hopefully with the $80 billion.
We're getting a little ahead of ourselves there, Patrick, with some of the uses for the funds, but yeah, it's definitely going to be interesting to watch. Another component on the climate front is the home energy credits. Larry, what do we see there?
So there are two really important things here, I think. First is on non-residential solar credits, which means like solar panels for your house and battery systems and things like that. So there's a credit right now before this bill passed that you got 26% of the cost as a credit. Okay, but next year in 2023, it was scheduled to drop down to 22%. This bill changes all that. It makes it even a more lucrative credit, increasing the credit amount to 30% and keeping it there for the next 10 years. So it definitely lowers the cost of installing solar in your house. But I know myself, I've looked at it recently and it still didn't quite make economic sense. So, your mileage may vary.
Mm-hmm. Interesting. So when we talk about that's a credit as well, right? That's the same structure as the EV, so dollar for dollar. And how does it work? Since they're separately stated, are you able to double dip? Can you take a credit from an EV and a credit from solar and get both back in the same year?
Most likely, they're going to be non-refundable credits, though. So you had to have a tax liability of at least that much.
Mm-hmm. Got it. And then, Patrick, do credits roll over from one year to the next? Can you carry them forward if they're non-refundable, or is it set it in 1 year and forget it kind of situation?
No, with the non-refundable credit, if you don't have a tax liability to offset it with, you're not going to be able to get the credit.
And so it doesn't carry forward.
No.
Got it. All right. So there's some structuring or timing things that people can think about purchases to maximize those credits. It's definitely something to consider and make sure you can see if you can qualify for as much as possible. All right. Then the last one or last thing we want to talk about in uses of the funds in the act are $80 billion have been allocated to the IRS. Patrick, how's this money going to be used?
So I know about half of it is set to be focused towards enforcement. And I think a lot of people are nervous that it means that there's going to be increased IRS audits, increased just examinations, just issues with taxpayers having to pay more with the IRS. I don't think that's necessarily the case. I think a lot of it is going to deal with hiring the right personnel, stopping some of the backlogs, improving technology, being able to process returns faster. I mean, as someone who works with the IRS on a pretty regular basis, the last thing you want to do is actually have to call the IRS and hope you get through. So, dealing with their antiquated systems, lack of personnel, I think should hopefully allow for better interaction for the general taxpayers as well as us as tax professionals. But realistically, I think it's just going to create hopefully a more smooth interaction with the IRS. For low-income taxpayers, can we get to the point where they don't have to file a tax return with third-party software? Can they work with the IRS directly for a true free filing, which we've seen issues with in the past? So I don't think it's necessarily increased exams and increased a tax hunt for our taxpayers. I think it's really just more increasing some of the efficiencies and updating outdated technology there at the service.
Makes sense. I think the term they're throwing around there is customer service, is treating the taxpayers as customers and improve the service they're receiving from the collection agency. And with that, though, they're going to invest $80 billion into the IRS. They do expect some sort of payback. Is that right, Larry? When we talk about how this bill is going to be paid for, we talked about previously the uses of the funds. What are the sources here that make this a revenue neutral bill?
So some in Congress are estimating this to have about a $200 billion increase in tax collections from the $80 billion investment. So that's the expected payback there.
So any idea, have they talked about where they expect it to come from? Or in the past, have there been studies that we've heard about loosely on the investment in the IRS gets a return typically of 2 to 3 to 1? Is that
So, I
So
mean, what
for
they're talking about here, there's actually no changes in the Internal Revenue Code. So the law doesn't change at all. So there's no actual tax increases here on most people. But what this is a way to improve IRS service and close the tax gap, or the difference between what the IRS and the government believe should be collected and what is actually collected. And so perhaps through better service, or maybe just folks complying a little bit more with the law, they expect to collect more revenue.
got it. That makes sense. Also on the, sticking with how this bill's paid for, there's a pass-through loss limitation. Larry, you mind talking about that a little bit more?
Yeah. So when if you're an owner or a partner in an S corp or a partnership, or even through a trust, and you have losses that are flowing through from those businesses that are otherwise allowed, and there's lots of complications to make things allowed. But once they are allowed, there is now and there has been in recent years, a cap on the amount of that loss that can be taken in a particular year, called the excess business loss limitation. And so what this law did is it extended it 2 more years. It was supposed to sunset at 2026, and now it goes through 2028.
Got it. And should that have an impact on some of our clients?
It certainly could. Yeah, absolutely. Yeah. I mean, it's important to think about and project and plan through passive activities and passive loss limitations and these things to see, what's going to happen.
Yeah, it's a live change for our clients, and something we'll be working on with them to make sure they're structured correctly. Awesome. Now, before this officially passed the Senate a week or two ago, after Joe Manchin and Chuck Schumer reached their deal, the bill kind of hung in the balance with one senator from Arizona named Kristen Sinema, who was a staunch proponent of not closing the carried interest loophole. And it all hung in the balance. She got her way, and they did not close the carried interest loophole as part of this bill. It's talked about a lot in the news, but Patrick, you mind giving us some info on what is the carried interest loophole?
Sure. So the carried interest loophole allows for people to get long-term capital gain treatment, which otherwise would be ordinary through investments, essentially. And so you'll see that thrown around in the private equity industry quite a bit. I know there was a lot of talk of extending the 3-year look back to treat it as ordinary to 5 years. That was unsuccessful, but it did live to see another day and continue to see that loophole where we could get preferential treatment for interests in partnerships and other investment entities that you otherwise wouldn't.
And so we say preferential treatment. That means that the income that they're earning is lower than they would if it were taxed as ordinary income. Is that what you're saying?
Yeah, you'll see this in the news a lot, where you'll see, names like Warren Buffett thrown around that their tax rate is much lower than the average W-2 earner. And that's true. For the most part, us as a W-2 employee are going to get our wages taxed at ordinary rates. However, some of these investors who have interest in a lot of vehicles are going to get long-term capital gains rate and likely going to be paying a substantially less tax rate than just your common earners. So, it's been a very big focus to close that gap and let them pay their fair share, but it's continued to survive.
All right, so we'll see how that plays out in the future, but no changes to the carried interest loophole. There is a change though in corporate taxes. They've instituted a 15% corporate minimum tax. Larry, who are the businesses that are impacted by this, and how are they going to actually apply this tax?
So the good news is that no one that we work with is impacted by this tax. But who is going to be impacted? It's going to be corporations that earn more than $1 billion in financial statement income per year. And so, with some exceptions, of course, there are carve-outs for certain groups like manufacturers. I'm sure it's going to be there for the new CHIPS Act passed for Intel to build and semiconductors here. What's important is that companies that invest in equipment, they get depreciation, right? Which is non-cash losses, tax losses, which makes their taxable income zero or a loss, but their financial statement income, which recovers those costs over a longer period of time, is higher. So For some industries that weren't favored, if you have $1 billion of financial statement income or more, well, now there's going to be a new minimum tax based on financial statement income. There's a lot of policy questions there, but that's what it is.
Got it. And so financial statement income is, oh, sorry, Patrick, cut you off, but just real quick, the financial statement income is the operative word. Patrick, what does that mean, and how does that differ from what we've seen in the past?
Sure. So it's a departure from where we normally view alternative minimum tax. Normally, you'd start with taxable income and you'd have your modifications to compute your alternative minimum. But here you're actually using GAAP as your starting point. So you're using true financial statement income, which is interesting, but I think goes in line more with the way that the global minimum corporate tax rate has like thoughts to play out. So I think that it's just trying to conform a little bit more with that. One of the other interesting things is that Larry mentioned it's not going to impact many corporations. I think they said it was going to be about 180 to 200 corporations, all Fortune 500, that are going to essentially be the ones that are going to foot the bill on this.
Wow, that's a pretty interesting fact. They threw it in there for less than 250, 300 businesses. It's pretty amazing.
Yeah.
Pretty
I think
targeted.
the expected revenue was around 300. I can't remember if it was million or billion, but it was a lot just based on those
Sure.
180 to 200 companies.
Sure. Yeah, makes sense. Definitely makes sense. And the last thing that they threw in here on corporations that we'll focus on today is a 1% excise tax on stock buybacks. How's that going to work, Patrick?
Sure. A number of people are upset with companies deciding to buy back stocks as opposed to issue dividends for a better tax treatment. And what it's going to do is outlines that if you're a publicly traded or on an exchange-based stock and you have a buyback, it's going to implement a 1% excise tax on that buyback.
And Larry, what does that mean? Patrick said that people are upset of companies buying back stock as opposed to issuing dividends from a tax perspective. Why would they be upset?
Well, when a company pays dividends today, there are taxes paid by all the recipients of those dividends upon receipt. When there's a buyback, the value of your shares, all the shareholders' shares, theoretically go up, but there's not a taxable event until those shares are sold. So there's a deferral mechanism.
Makes sense. Cool. Well, those are some of the highlights of the bill, fresh off the presses. It's going to be interesting to see how a lot of things that we talked about here play out. A lot of definitions to come, but we're here to guide our clients through these topics on a regular basis. If you're interested in learning more, please reach out to Larry, Patrick, or I. Find more information on our website or see more information on LinkedIn. We appreciate everybody's time today, and we'll talk soon. See you guys.
Bye, guys.